let's do if we have a parent-subsidiary relationship. About 20 of those. Okay, let's do a parent-subsidiary relationship. So let's say I'm investing in ABC company. Okay? And let's say ABC has 100,000 shares of stock. Let's keep it simple. Let's say the par is $1. Let's say the market value when I buy it is $10. Same example I used before, something like that. Okay? And then for the other ones, for equity method and bill for sale securities, right? Trading securities. What's the big difference if it's a subsidiary? How does it become a subsidiary? Okay. How much do you own if it's a subsidiary? Over 50%. What if you own less than 20? You have no control. And then you would use what? Market value method. And if you're going to hold it for a very short period of time, what is it? Trading security. If you're going to hold it from a very short period of time, 2 weeks, up through a year, what is it? But still short term. What is it if you're going to hold it for more than a year, but not forever? Those are so long. Okay. What is the bond if you're going to hold it forever? Investment held to maturity forever. The end of the bond, right? For the full term of the bond. If it's less than the full term of the bond, it's one of those other ones, isn't it? Everybody got the idea? But could it be a subsidiary? No. Could it be an investment affiliate? No. What does it have to be if it's a bond? And you know, even if you own a lot of it, right? A big chunk, right? A bond. It doesn't vote. So what is it if you own a whole bunch of the bond? You're going to hold it for more than a year. Avail for sale, long-term cap. We're there, right? Could a bond be a trading security? Sure, you're only going to hold it for a few weeks. Is that the idea? Okay, so this is where I own more than 50%. So let's say that I buy 75% of the stock. I'm now the parent, and this company's a subsidiary. Everybody agree? Okay? And then, so this is the time of the purchase, right? Okay, so now what I want, there's a market value of, I don't know, $9 at the end of the year. Okay, everybody got the idea? Why does Bellarmine Computers do this constantly? Constantly. Okay, all right. Anyway, $9 in the year, okay, market value. Let's say the net income for the year was $200,000. Okay, and let's have no dividend just to keep our life simple. Okay, so the net income is 200, right? And let's say dividends are nothing. All right. So what do we do at the time of the purchase, do you think? Oh, I should give you one other thing, right? At the time of the purchase, I think there are assets. We'll make it just be land, but it could be a whole bunch of different assets. Land has a book value of $250,000 on my balance sheet, okay? But I think the market value of that land is really $275,000, okay? So let's figure out what the entries would be for this thing. So it looks really hard. It's not really. Let's do the purchase. What does the purchase of the stock look like? What did I give up to buy the stock? Cash. What did I get? An investment in what? I'm going to buy 75% of the stock here. I'm going to be totally in control. This is control, right, guys? I have control of this company, right? So I'm XYZ company. I now own ABC company. Granted, I only own 75%. Somebody else owns 25%. Maybe a whole bunch of people, right? Used to be a publicly held company, right? Now I got 75% of it, right? Made a tender offer to all the shareholders, and 75% of them took the money, right? Got the idea? I'm in charge now, okay? I want it, right? XYZ company does. All right, anyway, so what would you call this? Investment in what? Yeah, just call it an investment in a subsidiary, and typically we put their name on it. What if I own 100 different companies? Would you like to have their name on there? So you tell them apart? Yeah, good idea. So ABC company, huh? You got it, okay? All right, how much did I pay for it? How many shares did I get? I know, I'm waking you guys up there. 75,000, right? What did I pay for each of them? $10. How much is that? How could anybody miss these questions, right? You certainly can't miss the investment, can you? Okay, now this is going to be a little different. Let's ignore for now the year-end stuff, okay? Let's just assume that we're going to, on the date that we bought this, right? Before anything happens, before there are any sales, right? Any costs, any expenses, before we do anything, before we run the company, before any time goes by, we want to do a consolidation. What I want to do is I want to combine the parent and the subsidiary. Now really, of course, you combine the parent and all the subsidiaries. Does that make sense, guys? If I have 200, I'm going to combine them all. So it's a big worksheet, but it's still the same idea. What am I going to want to do? I'm going to want to add together all the assets of all the companies, right? So if you have cash in all the different companies, and you own 200 different companies, what would you do? Add up the cash for all 200, that's the total cash you have control over. Everybody got the idea? Same with receivables, same with inventory, same with land, building, and equipment, same with all of their debt, right? Not the same with their equity, because those subsidiaries don't exist anymore. So we are going to, listen to this carefully, eliminate the equity, which means get rid of it. And what does the equity represent on the parent's books? On the subsidiary's books, you have the equity, right? Where would this 100,000 shares show up with a par of $1 and market value of $10? Where would that show up? Whose books is that on? ABC companies. What shows up on XYZ, the parent, right? What shows up on their books relating to that stuff? We just did it. We just recorded the investment. It's the investment. So this is on XYZ books. So this kind of hangs people up a little bit. What is going on? The parent's books, okay? This is the parent, okay? This goes on their books. So when I add the companies together, make these columns, right? For all the assets, liabilities, equity, revenue, expense, set them all side by side, right? I'm going to add them all up. What doesn't exist? The subsidiaries. So you get rid of what? All their equity. What else doesn't exist? The investment in yourself. When you put the companies in, what are you going to call it? Investment in myself? Subsidiary doesn't exist anymore. So you get rid of the investment in subsidiary. Now there's one other thing. We also get rid of all the revenue expenses that were intercompany. So if the parent's selling to the subsidiary is selling to the parent, got the idea? One has revenue, the other has expense. That didn't happen. You did business with yourself, so you have to eliminate that. So this gets to be a huge job. What if I sold some land to myself at a gain 10 years ago? Oh, that gain didn't exist. You got to get rid of that. Oh no. What if I sold myself some land or some building equipment a few years ago? That's got to be eliminated too. What else has to be eliminated? All the depreciation since you made the exchange. This is nuts. What if I borrow money from myself? There's no such thing as borrowing from yourself, right? The parent owes the subsidiary money or vice versa. That's all got to be eliminated. All the interest, revenue, interest expense on the two sides of the books, all that has to be eliminated. Here's the good news. We're not going to do that again. Okay? We're not going to go there. Let's do two of this. Okay, brothers? We're going to wait for a 400 level class to do that with the accountants. And everybody else, you'll just see the results of it. If you never do, thanks, accountant. Okay? Right? At least you'll know that we combine them, right? And we eliminate all the intercompany stuff. That's what I want you to know now. Okay? And I want you to be able to make this elimination entry at the time of the purchase. So, this is what's on the parent's books. What's on the subsidiary's books? This is a subsidiary over here. What do you think? This is the sub. Right? What's on their books? Well, there's 100,000 shares. There's a par value. The market value is not in their books, though. Oh, and this land is on their books. And I'm assuming that's the only asset that changes here. The reason you can change the market value, change to the market value on all the assets and the liabilities, by the way, is their money. Did you know that market value liabilities change over time? Sure you do. Which one have you even calculated the value of? Based on its interest rate, the stated rate, and the effective or market or yield rate. What do we call those things that we're calculating? Bonds. What happens every time the interest rate changes? What is the value of a bond every time interest rate changes? Interest rate goes up in the market. What happens to the value of your bond? Because your interest rate didn't change. Exactly. What if interest rates go down out in the market? You don't change yours. Your value goes up. They change constantly. The asset side, the investment, right, it changes. And guess what? The liability side changes by exactly the same amount. They're always working the same, of course. So you already know that. So what we could do is we could revalue those in a consolidation for one. Okay? If it's material. What do I mean by material? Big enough to make a difference in somebody's decision. That's how we decide what's material or not. Remember that? Okay, we talked about that. So if it's immaterial, I love materiality. If something's immaterial, what you do? Don't mess with it. Okay? So we'll assume that the debt's okay. And we'll assume all the other assets have to be market value except the land, right? You think that's realistic? Nah. What's happening is you're buying this other company, so we assume that, well, we can adjust the market value because what would you pay if you were buying a company right now? Market value. That's the idea, right? Is there going to be a gain or loss on buying something? No. We'll just revalue. There's no gain or loss on buying something. If you guys buy a car, you can gain. Making money, becoming wealthier by buying something, right? So one company buying another company, does that make them wealthier somehow? Should they have gains and losses on their income statement, something like that? No. Okay, not until they run the company. Okay, of course. Okay, good. Well, what would be on their books? I should have added a couple more accounts. We have to have something in common stock and probably something in additional paid-in capital on the common stock. Let's assume there's no preferred stock. And then we have retained earnings, I bet, all in the subsidiary, okay? Well, I think we could have calculated how much common stock they have. What was the credit to common stock over the life of the company if they have 100,000 shares outstanding and the par is $1? Now, what credit balance is in common stock right now? It's got to be $1 times the 100,000. It's 100,000. Absolutely. So let's assume this is 100,000, okay? And then let's say the stock sold on average for, I don't know, it's sold for $5 a share on average. So what number do we have in additional paid-in capital? If on average it sold for 5. Let's say we sold it all for cash. What would the debit have been to when they issued this stock? What do they get when they issue their stock? Cash. Be debit cash $5 a share times 100,000 shares on average, right? So 500,000 debit to cash, credit common stock 100, and what would the other credit go to? Additional paid-in capital. You guys know how to do this, don't you? I'll just give you those numbers. Nice person that I am. Okay, and then let's say that they have $300,000 of retained earnings. How did they get $300,000 retained earnings in the subsidiary? How'd that $300,000 show up there? Tell me where retained earnings comes from. You guys know? What does it start with when you start the business? What does every single account start with when you start the business? Before you've done anything. No investment, no anything. Right? No borrowing, no investment, no buying any assets. No revenue generated, no loss, or no expenses incurred. Nothing's happened. What's the balance in every single account? 0. Okay. Right, guys? So retained earnings starts at 0. How do you make it bigger? Yeah, net income. Everybody knows this, right? You guys do know this. Let yourself use it. In retained earnings, what would have happened is I start with nothing at the beginning. I add all the net incomes year after year after year after year for the entire life of the company, right? What do I take out? Dividends. What else might come out, unfortunately? Net losses. We're there, okay? And that'll give me my ending balance down here, right? All I'm saying, when I gave you the 300,000 here, what am I saying? The total of all the incomes over the life of the company, right? Less all the losses, less all the dividends is 300. I started that first day in here. Okay, you guys know this stuff, right? Let yourself use what you know. Okay. So here we go. What I want to do is come up with an entry that eliminates the subsidiary. So this journal entry is on the parents' books, right? On the subsidiaries books, we already have all these accounts. Everybody agree? They're already there. That's the whole equity of the subsidiary, say it is, right? I want to get rid of the equity of the subsidiary, and I want to get rid of the investment of the parent's books, but I'm not going to make a journal entry on either set of books because the debt is only equal to credit. It's only going to be a worksheet entry. So I've got this big worksheet, imagine 200 companies, right? I'm adding them all together. It's got 400 columns in it, okay? Actually, 402 because the parent has 2 columns, right? All the debits and credits of the parent are written down. And then every single subsidiary going across this massive spreadsheet, right? Imagine we used to do this on paper. It's unbelievable. It wasn't all one sheet of paper. You have supporting schedules, going into it. You combine groups of companies and then combine those groups and combine those groups. Now we can actually do one spreadsheet if you want it, right? Excel doesn't care how many columns there are. And they'll add them all up for you, right? You can do it if you want. Okay? So what's the deal here? I'm going to write down all the debits and credits for all the companies. And then I'm going to add them all together. But I'm going to write the total assets, liabilities, equity, revenue, expense. But I'm going to eliminate all the intercompany stuff. Okay? So we're going to assume there are no intercompany liabilities, assets, liabilities, right? Receivable, one payable to the other, to yourself, kind of. And no intercompany revenue. We're not going to touch it. This is just at the point that we make the purchase, okay? To eliminate. Just to give you the idea of what a consolidation looks like. So here's what I want you to know. This elimination entry goes on no one's books, okay? It's really important, or it just seems like this is crazy. Okay, this elimination journal entry, right? This elimination journal entry is on the worksheet only, okay? Just for worksheet purposes. You can't put it on anybody's books because these accounts are coming from different companies' books. That makes sense? Different companies' general ledgers. Okay, so when we're putting these companies together on this big spreadsheet, what are we going to try to do? I want to get rid of all the equity of the subsidiary, and I want to get rid of what on the parent's books? The investment in the subsidiary, right? Okay. Tell me how to get rid of the investment in the subsidiary. This journal entry is too easy to believe. What would you do? Credit it. It's got a debit balance for $750. What do you want to credit it for? $750. Okay. Investment in subsidiary, what do we call them? ABC. Take out whatever's in it. And by the way, if years have gone by, we take that out too. Right? We take out whatever the investment is now. If you're using the equity method for this company, what would happen? The investment would change. What we might use in a subsidiary is something called the cost method, and we don't change it. We don't apply it. We just leave it. Which makes more sense to you. You're going to eliminate it anyway. Okay. All right. So anyway, what we're going to do then is we are going to eliminate all the equity of the subsidiary too. How are you going to do that? Common stock has what kind of a balance in it? It's a credit. Get rid of it for me, guys. Debit common stock. Wow. This is too easy. Okay, additional paid in capital. Debit or credit, of course, it's an equity account. Credit, how would you get rid of it? Debit. Everybody staying with me? This is true, isn't it? Are you guys going to get these points? Why not? Right? Get rid of the investment. Get rid of the equity. What's the other piece of equity I have to get rid of? Retained earnings. It's credit balance, isn't it? Okay, positive retained earnings, right? What if it was negative retained earnings and it had a retained deficit? It'd be a debit balance. How would you get rid of it? Credit. I won't do that to you, but that's what you do, right? Okay, so retained earnings was 300. So I've got 800,000 here. Is that what that is? Oh no, that didn't work. My journal entry doesn't balance. I have debits of 800,000 and credits of 750. Must be something else. What did I suggest to you needs to be adjusted? In my general ledger, there's a whole bunch of assets, right? This is on the subsidiaries books. By the way, you wouldn't adjust the parents' books to market value. They weren't purchased, right? So you leave theirs where they're at, historical cost. The subsidiary was purchased by the parent, so we can adjust them to market value. Make some sense to you? That's the theory, okay? So the only asset I think where book value is different than market value, you guys know what book value means, right? It's the value in the books, in the general ledger, historical cost less depreciation. on building and equipment, historical cost on land. So this is what the company paid for the land way back when, right? It's $250. Now it's worth $275. That's all we're doing. Okay, so how do I increase land by $275? Only for the consolidation, because I'm not going to go change the books for the subsidiary, right? They still exist, operating independently. This is weird, isn't it? The subsidiaries still all exist. We're not merging. The author talks about mergers here. That's where you buy all their assets and assume all their liabilities, and they cease to exist. Now I got to purchase it. I would eliminate it permanently, basically, right, by buying their stuff. Okay. This is where the subsidiary continues to operate, continues to generate revenues and expenses. They're just controlled by the parent, and then you put them all together. This is extremely common. Companies, major corporations own a lot of other companies. Okay. And when you look at those financial statements in the book, what do they always say on a real consolidated? That's what we're talking about here, right? The subsidiary still exists. They're still operating. Okay, good. You read about that. All right, anyway, so what do we want to do with this? What do you want to do to land, you guys? You got it? Now do we balance? Oh, no. We don't. What's wrong? What's missing? I only own 75% of this. I got it. Who owns the rest? Minority interest. Those minority shareholders. They own the rest. Now, what do they own? Okay, the equity was how much total? How much is this equity total up here? It's those right there. How much was it? $800,000. What portion do I own? 75%. Everybody agree? So we got the equity of the subsidiary. It's an ABC company, right? It's $800,000. Okay. The minority interest is how much of that? I own 75%. What do the minority shareholders own? 25%. How much is that? $200,000. Everybody agree? Everybody agree with that? Got $800,000 equity. They own a quarter of it. That's $200,000, right? So what I do with their share of the equity is I debit common stock, additional paid-in capital, and retained earnings, right? There's a whole $800,000 there, right? But 200 of it was theirs, and they still own that. I don't. So guess what we do? We show as this quasi-equity account 200, and I say quasi because they don't have a vote. They do, but it doesn't make any difference. They only own 25%, right? Does that make sense? So they don't have any control. Okay? No control. They have against the vote, right? Right? And we can't steal their money from them or something, or they just sue us, of course. Okay? The majority shareholders. So we can't buy their rights or something. Okay? But take away their value. But anyway, they got 200 of that 800,000 is theirs. So what did I buy? What's the parent's share? What do they have? The parent. What do we have? What do we have as the parent? 75%, which is how much? 600,000. Now this gets tough. Are we in balance? Let's see. I've got 825,000 of debits, and I have 950,000 credits. We're not in balance, are we? Huh. I paid how much to buy this company? What's my investment, my cost to buy this? I bought 600,000, right? 3/4 of the 800. I bought 600. What did I pay for it? 750. What's the excess I paid? You got to get so you understand this for it to really work. See it fall out for you. What's the excess we paid? 150. How much am I out of balance by? What's the total debits? 825. What's the total credits? 950. I need a debit of how much? Only 125. Wait a minute. That's 150 was the excess. Ah, increase in land. I bought $25,000 increase in market value of land, right? So what's the excess now? If the extra 150 I paid, 25 was for land, what's left, you guys? 125. Now, this is tough. I told, back when we were doing intangible assets, I told you guys, the only time you can get something is when one company buys another company, because it's the only time we can value it. What's it called? Goodwill. This is goodwill. This is where goodwill comes from, which is another reason I want to do this with you guys. You're going to see goodwill, big numbers in consolidated financial statements. What is it? It's the amount, and this is going to sound familiar, I hope, to you. It is, I've even quizzed you and tested it on it, haven't I? Goodwill. It is what? The excess that you paid to buy the stock over the fair market value, or I'm sorry, over the fair market value of all the assets you bought, less the fair market value of the liabilities that you assumed, right? It's the excess you paid that we can't identify. What's it for? Why would you be willing to pay an extra $125,000 for this company? Because they have what? A reputation you want, employees you want. Are those on the books? No. Vendor relationships you want, government relationships you want, products that are better than other people, right? It's not on the books, right? I went to, I'm going to go over to Lexington. I went to a couple of breweries. West 6 Brewing. You guys would be 21. Very good. Very good. You've been there? Heather there? Heard of it? Anyway, it's very good. You don't know. Okay, very good. Aren't you? Oh, no. Oh, bad. Okay. Anyway, so, very good beer, right? Very good beer. It's goodwill, you guys. They know how to make beer. Really nice idea. Okay. Very good. Almost everybody is IPA. The vast majority of them aren't worth drinking. Theirs is good. What is it? They have somebody who knows how to make beer working there, right? Maybe owns it. I don't know. Right? That's goodwill. It just is. I didn't go to other places, right? That exist. The idea, gave them my money. That's goodwill. Future cash flows you're going to get as a result. Oh, we think when we buy this company, there's $125,000 value out there that I'm going to get in future cash flows. And you know what? The discounted present value of all those future cash flows is the excess I was willing to pay. You guys know how to calculate the discounted present value things, right? You could value businesses. We are going to do it in 211, accounting 211. If you don't do accounting 211, you're going to do it in DB 315, right? Anyway. By the way, if you do it in 211, it makes DB 315 really easy. It comes later. Already got it. Okay. Anyway, any double majors in accounting and finance in here? Yeah, okay. One crazy. Yeah. That's a rough road, but it's really valuable. Really valuable. Okay, gang. So, does my journal entry balance? Oh, I better say goodwill here, huh? Does my journal entry balance? Okay. So, how did I get goodwill? I took the amount I paid, right, which was $750, and compared it to the book value of the equity I bought, which was $600, right? How is it $600? The total equity is $800, right, guys? 75% of that is what I bought. So the book value I bought was $600. Does everybody see that? If it's $800 total equity, and what are the accounts that make up equity? Common stock, additional paid-in capital, common stock, and retained earnings. And by the way, what if the company had preferred stock and additional paid-in capital on that? You'd have to eliminate that too, okay? Right? Well, I won't do that to you. So to speak, get more complex, obviously. Okay? Good deal. Now, what happens with the market value changing at year end? So what? I didn't buy a subsidiary for changes in market value. I'm not going to sell the stock. So I don't do anything with it. Just like if we were using the equity method, huh? What would I do with the net income? If I use the cost method, so what? I don't care. I'm not going to do anything with it. Because you know what I'm going to do when I add the two companies together? I'm going to eliminate any intercompany revenues and expenses anyway. And the 25% that belongs to the minority shareholders of that gain, that net income for the subsidiary, that's going to change minority interest because they own 25% or more retained earnings change, right? So it's not a big deal. And the dividends is a little different. I have a cash and credit dividend revenue, but it's dividends to myself, so what would you have to do? Eliminate the dividend revenue and adjust retained earnings of the subsidiary. We won't go there, right? But that's all it is. Okay, it all just makes sense. Remember I told you guys right from the beginning, you really want to understand accounting, you really want to understand business, you don't want to memorize it. I recommend to you, who was it says, you want to start a bakery. That's cool. By the way, you guys, you think her bakery will be successful if she manages the business side of it, having eaten her pastries? Oh wow, yeah, oh yeah. First thing you got to have is really the product. Right? You got to differentiate yourself. That'd be good. Her problem's going to be she's going to give away way too much of it. If she does, you're going to give away way too much of it. And what did I tell you should charge people like me? 5 times what it costs you to produce it. So then she gave a whole bunch of charity, right? People who can't afford to buy it and still survive. But if she only charges me a fair price, a reasonable, what I would think is a fair price, a reasonable return, then she can't give any away. She'll barely make it. Just charge everything or not give it to them. But I think it's just fine. It's sort of a form of taxation. You know, people when they go to shopping malls, they buy those cookies. What's the cookies? What's it called? I don't know. There's a place that sells cookies. Mrs. Fields or something. Used to be somebody else now. Can you buy a big cookie?
Like
Great American Cookie Company or something. How much you pay for a cookie?
They have like 15 different kinds.
Yeah, and their prices range from something somebody could afford to something that's just absurd, right? You know, ridiculous. And people go and pay $5 for a cookie, right, guys? You know, or $4 for a cookie. Yeah, that's what you gotta do. Okay, and then they can stay in business. They gotta get around, right? It's expensive to have a cookie company. Okay. By the way, what will be the goodwill portion of that business? You know how to bake. And you're competing with people who don't, or don't care, right? I'm going to make it cheaper. I'm going to make it cheap. And maybe not as good on purpose. So, and then, by the way, can that strategy work for you too? Yeah, you might get really big, right? But do you agree? There are gourmet donuts, and then there's, what's the place? Krispy Kreme. Krispy Kreme is junk donuts. People are addicted to them, right? But they're not good for eating. They just do it, right? There's McDonald's and then there's Outback. They both sell beef, huh? I think McDonald's has beef in it, I'm not sure, but it probably does. They're a little bit different places, aren't they? I bet you guys can relate to Bruce Chris. Okay. All right. Okay, gang. Enough on this? You're perfectly good? Now we got a data review. A good day to get caught up. All right, so let's do cash flows, huh? Let's switch gears completely, and let's do cash flows. Okay. New chapter. Here we go. We are going to do cash flows. What I want you to do is pull out that problem I gave you. Which one do you want to work? Going to do Eaton Company first or Foxborough first? We'll do the other one next time. Eaton looks more like a regular financial statement, doesn't it? Here's the deal. I gave you 2 problems that look really different and have exactly the same information. But you hear that? They look different, but they have exactly the same information. You take charge of the problems. There's been a lot of times in this class, huh? Remember that now that we're getting, the big points here, right? Last quiz, last test, right? The final. How many points do we have left to go? 330. How many are we going to have total? 650. So about half of them. Okay. Okay? Don't make this quiz be the one you throw away, right? I bet almost all of you, maybe all of you, have one you'd like to throw away. Don't let this be one of them. The one you have to throw away because it's the worst one. Okay, we're throwing away one quiz, right? Don't let this be it. Get a 30 on this. Okay? Bump it. All right, anyway, and this is going to be really, really straightforward. This quiz is just really straightforward, I can get. Can you do trading securities, availed or sell short term, availed for sale long term, equity method, and a consolidation. Big bite, right? That's what's in that chapter. Consolidation's not even really in the chapter I have that. Okay, so can you do it? Yeah, you could. You work at it, right? And then can you add doing a cash flow statement? The cash flow statement is going to be 15 points, right? Then of the test, how many chapters are on the test? Is it 4 or 5? 4 maybe. 25 points then? 20 to 25. 20 to 25 points in there somewhere. Okay? So now what are we up to? 15 and 20 to 25, 35 to 40. Another 20 in the final. One problem. And I know we're at the end of the semester and you're tired, right? You're tired a long time. You want to learn one more problem? Please, please, please. Looking after your grade, you can do this problem. And when do you want to know it? At the quiz? Or just for the final? Yeah, let's do all of it, right? Let's have it on the quiz, let's have it on the test, let's have it on the final. Don't wait for the final. Okay? Doesn't work. Okay, so come on. All right, anyway, you know what this statement does? It just writes down on a piece of paper all the changes in the assets and liabilities. And it writes them down once and only once, including the change in cash. But the change in cash is going to be the total of the statement. This is the nicest problem. How would you like to do it's a pretty big math problem, right? But how would you like to do a math problem where they give you the answer before you start? Isn't that nice? We are going to know the answer before we start. And then we'll just work until we get to the answer. Okay? But listen to this really carefully. I want you to write down the change. Explain the change in every asset, liability, right? And equity account, right? I want you to write down the change in all of them except for cash. And then I want you to add them all up and get the total change in cash. Are you guys aware that debits equal credits? Are you aware that all the assets are debits except for common equity? And all the liabilities and equity are credits except for the common? You guys aware of this stuff? Are you aware that the debits equal the credits? If you wrote down the changes in all the assets, liabilities, and equity except for cash, you're writing down a bunch of debits and credits, aren't you? And then you're adding them all up. What do they have to total to? The change in cash. That's all this is. You have to know where to put it. That's all. So I'm going to show you where to put it. So don't memorize this. It's too much, right? Understand it, and it's easy. This is going to be one of those quizzes where a whole bunch of you are going to get 15 out of 15 on this problem, and some of you are going to get 0, or 1, or 2. And I think the difference is the ones who get 15 know what the hell they're doing. What do you think? And the ones who get 1 or 2 are just whatever. Oh, wow, I can't remember where that goes. Well, neither can I. Right? Why bother? How many possible balance sheet transfers? How many different names could you have on a balance sheet? Pretty much infinity. How many different assets can you own? Come on. Right? Okay. But they go into specific categories. So all right, so that's the trick. So here's what we're going to do. We are going to put at the top of the statement. This is really clever. Don't look at the answers while you do these, right? Don't look at it now either. Let's do Eaton Company. Okay? The very first thing I want you to do is write, when you do a financial statement, always do this. Write down the company name. You like that? I bet you that you will get some points. Not many. So you might get a point or two for doing that. Write down the company name. Okay? All right. Then name the statement. What is this? Statement of cash flows or cash flow statement? I can care less which one you call it. Both of these. And then you need to write down a date, don't you? We would for a balance sheet, we would for an income statement, we would for a equity statement, we would, wouldn't we? Okay? We're going to do it for a cash flow statement. Now, is this a specific date or for a period ended? Now, I want you to think about this. We start with the beginning balance and we work our way down to the ending balance. Is that for a period ended or for all time? It's not the beginning cash that we started the business with, that would be 0, right? It's just for the year, isn't it? So what do you want to write on this statement? For the year ended. Just like an income statement where we close the books and start over, right? Just like an equity statement where we start with the beginning balance and go down to the end. What do we do on the balance sheet, seeing as we never closed those accounts? We say as of a date, really nobody does that. You just say the date, right? You put the date down. But it's just that date, isn't it? Not really. What is it? It's a picture where you're at that day, but what's that an accumulation? Everything that happened in the entire life of the company, right? When you look at cash on a general ledger, that's all the cash that ever came into the business, less all the cash that ever went out. The cash in my wallet here is all the cash my wife ever put in there, less all the cash she ever took out, right? I'm kidding, seriously. Right? I have absolutely no idea how much is in here. Especially if it does people. Look at that. 5, 10, 11, 12, 13, 14. Man, I'm rich. Oh yeah, 14. How much cash has been put into this thing? I don't have a clue. How much cash has come out? I don't have a clue. A lot, right? But I do know what's in there. That's what a balance sheet does, huh? Right? You keep track of everything you have come in, everything does. That's not just cash. That's every single asset, every single liability, every single equity account. Am I right, guys? We already did with retained earnings. This is sort of a review from the beginning. This whole statement is a review of everything we've done. Oh, if you know what the journal entries are, you can do this. If you don't know what the journal entries are to get your balance sheet and income statement, this is real hard. Okay, so you guys want to do for the year ended? What year was it anyway? 12/31/2000. Okay? Yeah, so do that. Okay, there are 3 sections on this statement, and they're upside down. When you start a business, what do you do first? I said we're going to analyze the balance sheet, right, guys? What do you do first when you start a business? First, I sell stuff, right? No, I don't. You don't have anything to sell. You want to do what? Yeah, where do you get it? No, you don't. Okay, let's today go to the bank and ask them to borrow $100,000. You want it? How much are they going to laugh at us if we just walk in there and we say, oh, we're starting a new business. Can we have $100,000, please? They won't even talk to us. We're not even in the office. What do you have to have? Investors. Yeah, investors, which is probably going to be us if we want to start a business. So if we want to borrow $100,000, what do you bet we have to plunk down some of our own first? You got $100,000 to start a business? High risk starting a business. Me anyway, I don't want to work. Okay, so it's hard work. So what's the deal first? I am going to go get what? Contributed capital, right? So the first thing that's going to come in is contributed capital. Would everybody agree with that? First thing I do is I have contributed capital, which of course is cash, right? Or other assets coming in. Everybody agree with that? That's really the first thing that happens. And then what would you immediately do? Well, maybe not. Maybe the first thing I do is now go to the bank. Because we need more than just our cash. We want theirs too. And we want them in the game too. So what would we probably do next? Long-term debt. What do you think? So what happens is we get the money from contributed capital, from owners, right? Get cash and other assets. And we acquire long-term debt to get more cash. And now we're going to run the business. Well, what do we use all that cash to do? What's the second thing we do? After you have, you get all set up. You get the equity contributed, right? The initial stockholders put their money in. Us, if we're starting the business, right? Okay? And then we go and we get somebody to put up some of their money, loan it to us, right? Okay? So we can use their money and our money running the business. Good deal. And, if we put in enough money, they'll put in some money. I'm sure. Decent risk. Okay? Who loses theirs first if we start losing money? Who's taking most of the risk? Who's taking the big chunk of the risk? The debt holders or the equity holders? Equity holders, sure. Who gets paid in a liquidation? You close down the business. Who gets paid first? All the debt holders. So let's say we put in $100,000 of our money. You're the banker. You put in $100,000 of yours, and we lose $100,000. You still get yours. When you force us to liquidate the company because you're doing such a horrible job. You now own it, right? All there is, there's 100,000 assets left, 100,000 liabilities, and 0 equity. Who's going to get it when they liquidate the company? The debt holder is, right? Okay, so sure they'd loan it if we put in our own money. What if we put in nothing? Are they going to give us 100,000? 100,000 assets, 100,000 debt, 0 equity, and we start running the business. What happens if we lose money? Now we've lost the banker's money. Got the idea? They don't want us to lose their money. They want us to lose our money if we're going to lose. Okay, that's why you have to put in your own. Everybody got it? Who's taking the risk? Okay. By the way, does the banker still take risk? Sure, we could lose the whole 200,000, right? Everybody got the idea? We can lose our money and theirs, but we're going to lose ours first. Okay, anyway. So what are we going to do with all that money? You said we're going to start selling product, buy inventory, and sell, but probably we'd make an investment first in land. Well, maybe. Land. Probably land, building, and equipment. Probably non-current assets of some kind. Probably. Okay? Particularly if we were going to produce a product. Right? I mean, you could rent your store and you could rent your plant. You know, you could rent everything. But more likely, you'll probably buy a bunch of stuff. You could rent all your delivery trucks and stuff. But probably you'll buy things instead. Okay? So what I'm going to do is I'm going to invest in what? Non-current assets. Okay? That makes sense, guys? All right. Now, what we're going to call these things, these three categories. At the bottom of the statement, I told you it's upside down. At the bottom of the statement, I am going to put in cash flow from financing activities, okay? So financing activities. Now get this down. This is really important. This is what's going to make it easy for you. Financing activities goes at the bottom of the statement, right? Okay, the bottom third of the statement about. Okay? What that is what? Where does the financing come from to buy our non-current assets and then run the business? Where do we get it from? Equity holders and long-term debt holders. So what I'm going to put in here is all the equity transactions with the exception of net income. Okay? So what's going to come in here is contributed capital, owners investing. Buying back treasury stock would go in there. It's equity transaction, right? Equity transactions, okay? And I'm going to put in dividends in here because that's a transaction with the equity holders. Would everybody agree? They contribute capital and we pay them a dividend, huh? Okay, that's the big things, right? So that's financing activities. So that's one category, okay? That's about the bottom third of the statement. Then what happens after we get the financing is we invest in these non-current assets. Land, building, equipment, whatever, okay? The non-current assets. That we are going to call investing activities. And this hangs people up because is investing in contributed capital investing? Yes, for the investor, but not for the company. It's financing for the company, right? It's a type of financing. Everybody got the idea? So remember which side of the deal you're on. So that's kind of confusing. Investing activities. Activity. Can't spell it. Activity. Still can't spell. Even I. Activities. Okay. Investing activities. What's going to go in here? Non-current assets. Okay? Wow. And then there's one other thing we do. After we buy all these assets, after we get all the money in, right, from equity holders, from long-term debt holders, right, bonds, maybe, okay? We buy all these assets, and then we start to do what? Operate. And you know what we get from operations? What do we get from operations? Revenues and gains, expenses and losses, and the difference is net income. We already know how to do all this, huh? And where does that go? Into retained earnings, doesn't it? Right? Now here's the thing about retained earnings that makes it hard. Net incomes or net losses come into retained earnings. Am I right, guys? So do dividends. Okay? So the dividend here, we're going to put down here. Okay? It's financing activity. It's a payout to the owners. It's not an expense, is it? Remember I beat you guys up for that? Don't call dividends an expense. Taking some of the profit out of the business doesn't make it less profitable, right? It's not an expense, it's just a withdrawal by the owners. So the dividends go down here under financing. It's paying back some of it to the owners, right? Some of what they put in, okay? Where do we put the net income, though? That goes under a section at the top called operating activities, for operations. Either term is fine. Got it? So I got three sections. Financing, investing, operating. Under operating, I'll put my net income, my net loss. Okay, now here's the other thing you do when you're doing this statement. You pretend everything affected cash. even though it doesn't really. Are you aware that debit accounts receivable and credit sales doesn't change cash? But we pretend a change in accounts receivable changes cash, okay? Right? We pretend the net income is all for cash at first here. And then what we're going to do is we're going to adjust to what it would have been if it was really cash basis. That's what we're going to do on this statement, okay? By the way, those of you who take 211, we're going to actually convert accrual to cash and from cash to accrual. What's cash basis accounting? When cash comes in, I debit cash, credit something. Cash doesn't come in, I don't have a journal entry. When cash goes out, I credit cash and debit something. Cash doesn't go out, I don't have a journal entry. There's no such thing as accruals and deferrals, right? Do you really know how much you earned then if you don't record your receivables? You don't record your payables. You don't record your prepaid. And you don't record your unearned revenue. Just don't do that. Oh, you don't record depreciation either. Right? Nothing, right? So cash basis, no cash income went out. That's what this statement's for. Your accrual basis, right? There's your financial statements at accrual basis. And now we're showing people where the cash came from and where it went. So effectively, we're converting the cash basis in the operations section of this. Where cash basis came from. Okay? That's basically what we're doing. So in 211, it'll be really nice to have this down and we'll start doing that right at the beginning of the course. Okay, anyway, so I've got net income or net loss in here. Everybody got the idea? Now, we got more things though. That took care of the income statement totally, right? That one line takes care of the income statement totally. Everybody agree with that? And, by the way, have you noticed I haven't written any numbers down here? I haven't done anything yet. If you understand where things go in this statement, this kind of is a joke to do this problem. Just boom, 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 boom. Just mechanical. Nothing to it. So I want you to understand first, and then we'll do it, okay? And then it's just mechanical. And at first it'll seem that way. Think, well, I just plug numbers into all these squares and I'm up and I got it. Yeah, that's right. All you're doing is taking the differences, the changes in the balance sheet and writing them down. So once and only once. What happens if you write down the change in, I don't know, accounts receivable twice? You'll be off by that amount when you have the change, you get the change in cash, right? What if you fail to write one down? You'll be off by that amount when you add them all up, right? It's got to be all of them once and only once, okay? That's the trick. So when you do an account, do the whole account is what I would suggest, okay? From any account from the balance sheet. All right, anyway, so what else do I have? I've got all my equity taken care of here. Everybody agree? I've got all my long-term debt taken care of here, and I've got all my non-current assets here. What else is on the balance sheet? Huh? Oh, current assets. She's brilliant. Okay, I've got current assets too in here, don't I? What else do I have? Sort of along the same line. I've got all the equity taken care of. I've got all the long-term debt taken care of. I've got the non-current assets taken care of. Now we're going to do current assets. What else is there? Well, come on, you guys. Current liabilities, yeah. Like it can't be that easy. Yes, it is. Okay. Current assets and current liabilities. I want to do something with them. Okay. Now, why do you have current assets? Why do you have accounts receivable? I want to get more sales. It's debit accounts receivable, credit sales. If I don't grant credit, my competitors do. They have more sales than me, right? If you want to buy an account, and I don't sell an account, so that my competitor does, what are you going to do? You buy them. So why do I grant credit? Get more sales. So why do I have receivables? Get more sales, get more income, start of operations. Why do I have inventory? You think Walmart really wants to have that store full of stuff? No, they want your money. Why do they have a store full of stuff? So that you're coming and give them your money. That's it. They don't want that. Why do they have it? To get sales, right? And it's going to cost goods sold as part of operations. Why do we have prepaid? Because we have to. The insurance company makes us pay them in advance. If we don't, or maybe our landlord does prepaid rent too. If we don't pay in advance, we can't be in business. So we do. It's part of our operations. Everybody got the idea? How about accounts payable? I like accounts payable. So they don't have to give them my cash until later, right? It's interest-free borrowing. So I like accounts payable as long as it doesn't get so big that I can't pay it, right? But I like accounts payable. And that's part of what this statement's for, is to help you manage cash, right? You don't want to run out of cash. It's important. I think making a profit is more important than cash. But in the future, I'm not going to have any cash if I lose money now, right? That's going to happen to me. Okay, so I'm managing both, of course. Okay. So why do I have accounts payable? Because I can. I need debit inventory and credit accounts payable, not have to pay for it, go ahead and sell it. Have the cost of goods sold and credit inventory, and then pay for it yet. If I negotiate real long terms, it's nice, huh? And maybe then they pay me, right, for the sale, right? Debit cash, credit sales, and I haven't even paid for it yet. So one of the ways companies like Walmart makes a lot of money. They sell for cash, and they get really long terms out of their suppliers. They're selling you stuff they haven't bought yet, haven't paid for yet. They bought it, but they haven't paid for it. Time value money, what a deal, huh? I have clients that were like that. They had 90 days to pay on their accounts payable, and they sold everything for cash. Wow, what a money machine that can become. So they make a profit off the sale, and they make a profit off the use of the money. Right? The insurance companies, that's how they make a lot of their money. So you guys all pay your insurance premiums in advance? Yes, you do. What do they do with it? They invest it. Who keeps the earnings? You or them? They do. Theoretically, it gives us lower insurance rates. Okay. But they make lots of money. Who owns all the big buildings downtown? Insurance companies and banks. We've got all our money. Those two folks, right? Okay. Man has some nice buildings over there. All over town. All of the managed operations are local now, though they moved it off. Nice deal, huh? Did you see GE might be selling appliance parts? Does that mean they're going to move appliance parts to some other city? I doubt it. They just made a whole bunch of investments. All kinds of new equipment, buildings and stuff out there. It'd be really strange if I had to close it. So they probably are not letting it. But it's going to be a different owner, right? It's GE anymore, probably. Okay, anyway. So, what am I going to do with the current assets and current liabilities? What are the accrued liabilities? Same thing. I don't have to pay my employees right now. I don't have to pay the interest right now. Okay, so guys, where are they going to go? Under operations. So what I'm going to do is I'm going to put the changes in the current assets here and the changes in the current liabilities here. Oh. Okay, gang. For the balance sheet, where does everything go? Oh, one other thing. Where does cash go? These are current assets and current other than cash and all the current liabilities. Cash goes down at the bottom. When we add these up, it's going to give you the change in cash, okay? And then I'm going to add the beginning cash, and guess what that'll give me? The ending cash. It's just a miracle, right? It's a miracle how that works out. If we add up the change in every single account on the balance sheet, we will get the change in cash down here, okay? So when I add up my operating activities, my total. When I add up my investing activities, my total. And when I add up my financing activities, my total. These three are going to add up to the change in cash here, okay? Change in cash. And then I add my beginning cash to that, and guess what? That gives me my ending cash, and that's the whole statement. So what could you do? So again, where does everything go? Cash goes down here. All the current assets go up here. All the current liabilities go up here. All the non-current assets go here. All the non-current liabilities and equity go here. You know where everything goes. So if you see a non-current liability, what is that? What kind of activity is the non-current liability going to be? Non-current liability. Non-current. Where does it go? Where does the debt go? Long-term debt. Where does it go, you guys? Under financing activities. Okay, I didn't write it down. Sorry, I wonder you got that wrong. Okay, non-current liabilities and equity go under financing. Remember I said the bonds, you issue bonds, non-current liability, that's financing activity. If I issue a mortgage on a building, that's financing activity. Okay? Which liabilities go under operations? The current ones. Okay? So again, where do the current assets go? Under operating activities, because I have them to run my operations. Accounts receivable, inventory, prepaid. What's under current liabilities? Or where do current liabilities go? Under operating activities. Why? They're accounts payable, accrued liabilities. Got the idea? They're for operating my company. Where do the non-current assets go? Under investing is what I invested in. Okay? Where does the long-term debt go? Should have written it down. Under financing, right? Where does the equity go? Under financing, with the exception of what? These are under financing activities, right?
Net income.
with the exception of the net income, and that goes where? Under operations. You got it made if you know this stuff, you guys. One other thing. What happens if I have non-cash expenses and revenues? Non-cash expenses and revenues. And we're just going to do one expense. It can get complicated, but we'll just do one expense for that. Depreciation.
Wouldn't we still record it just as if it is cash?
You have a depreciation expense and credit accumulated depreciation. There's no cash though. And I want to adjust the net income from accrual basis to cash basis. What should I do? Add it back in operations. That's it. And that's why it's there. Okay? Add it back in operations. So the reason is not that it generates any cash for you. It's that it doesn't use any. The net income, what's included in these expenses over here? Depreciation and other items that are not cash, by the way. And there might be revenues that are not cash, too. But deferred revenues or that kind of thing. Okay? But anyway, your expenses, right? Depreciation expense. Debit depreciation expense reduces net income. Does everybody agree with that? When you debit depreciation expense, you reduce net income. So this net income that you're putting on your cash flow statement is too low from a cash basis standpoint. So what do? We add back accumulated depreciation. So another one that comes in here is the depreciation expense. Okay? It's the depreciation expense for the year gets added to it. Okay? Then one other thing that makes this really hairy. If I am having transactions on non-current assets or non-current liabilities where I have gains and losses, where does the gain or loss go? Into the income statement. But they don't have anything to do with operations. So we'll have to take those gains and losses, say on selling land, building equipment, we'll have to take those gains and losses and adjust net income for them. Because I want the gain or loss on selling non-current assets to go down here in investing activities, okay? I want the gain or loss on financing. I won't give you any of those, but if we did have some. On long-term debt transactions, financing activities, I want that gain or loss to be where? Down in here in financing activities. But where have I recorded it? I've recorded it on my income statement, okay? So that just drives you crazy a little bit here, okay? I'll show you how to do that. So what we're going to do is we are going to put the gains and losses in here. Now think about that. This is going to be kind of strange. If I put a gain on the income statement that doesn't have anything to do with operating income, what do I need to do? It's included in net income, right? But I wish it weren't. What am I going to have to do? Subtract the gain. No kidding. Okay. Seems backwards, doesn't it? Subtract the gain to get down to cash. Okay. What are you going to do with the loss? I'm going to add back the loss. Okay? So add back the losses, add back the expenses, right? To get the cash basis. And then I can subtract the gains. Wow. So when you read this chapter, it's kind of go, oh, it's going all over the place, isn't it? Okay? What we'll try to do here is make it fairly simple. Okay? So let's try one. Let's do this problem. Let's give it a shot. What do you want to do first? Eat and company. Right? And you can abbreviate for me, right? You get into next class later, don't do that. Unless you tell me. Statement of cash flows. I don't know about Richard Schrader. You can do that. Statement of cash flows for the year ended and put the date, okay? 12/31, whatever it was, 2002. Okay, what are the three sections? Write down operating. Operating activities. And then go down about half the page, okay? And put down one. Okay. You're going to get points for doing this. Get it set up, okay? And then what? Financing. Very good. And then way down at the bottom of the statement, what do you want to do? Increase or decrease in cash. Okay, let's look at cash. By the way, take a pencil or a pen, and as you do the problem, check off each account as you do it. Write down the change once and only once, okay? So put a check mark next to it, you know you did. You won't come back and grab it again, okay? So what happened to cash? Up or down? I don't know about you guys, but I think 4 is less than 11. Come on. Right? It went down, didn't it? Confidence. Come on. Decrease in cash. No kidding. Put brackets around it. Indicate that it went down. How much was it? 7? 7,000 or whatever this is, 7 million or something. Write down the beginning cash. How much was that? 11. What's the ending cash? I'm not kidding. This is too easy to believe, isn't it? What is it? 4. I probably have on a test 1, 2, 3, 4 points out of 25. Can you do that? Come on, right? Okay. Please, please, please give these points. All right? Okay, I want you to have them. Then what am I going to do? I'm going to start analyzing what goes where. Okay, where should I start? Oh, by the way, what account should I put a check mark next to? I already screwed up. Cash. I wrote cash down. I'm done with cash. I wrote down the change in cash, didn't I? Everybody got it? Check it out. Then you can go in any order you want. I don't care. If you remember what goes in what comes first, if you remember net income's first under operations, great. If you have net income, you have more or less cash. If nothing else changes, we pretend everything was for cash. What's the deal? If you make money, you have more cash, right? What if it's a net loss? Put brackets around it, you have less cash, okay? All of the things held equal. Didn't really happen, but we pretend. Okay, so let's start doing this. Let's go. What do you want to do? You want to start with net income? It's okay, but what account am I analyzing when I do net income? Where on the balance sheet does net income go? Retained earnings. So if you want to put down net income first, I'm just fine with doing that. I have no problem whatsoever with it. Oh, by the way, when I add up my operating section here, plus my investing section here, right, plus my financing, boy, I left a lot of room for that, didn't I? Plus my financing section here, what are they going to add up to? What's this, plus this, plus this going to add up to? -7. Like I said, I already know my answer. When I start the problem, I already know my answer, okay? Don't put cash down last, right? I wouldn't. Besides, you can get points for it. So when I write down net income, though, what am I analyzing? Retained earnings, right, guys? So be sure to do that, okay? How much was the net income? Right there on the income statement. What is it? 56. Put a check mark next to it. I wrote it down. I have more cash than before I made that money, okay? I pretend all the revenues were for cash and all the expenses were for cash. They weren't really, but for now, I'm pretending that. So where does net income go in retained earnings? Credits it, doesn't it? Everybody agree? What's the beginning of retained earnings? Anybody know? It's a retained earnings account. What was the beginning? 92. What's the ending? 132. How much did it go up by? 40, but I added 56 and only went up by 40. What must have happened? They must have paid a dividend, or at least declared a dividend of 16, right, guys? They told us that, but they didn't have to. I love to give you problems where I don't tell you something, right? You know that. So what if I didn't know what dividends were? Big deal. I do know what they are, right? So how much retained earnings went down by? All right, you put over here the net income, didn't you? What else do I have to do to explain that change in retained earnings? I need to explain a change of 40, and I already wrote down 56, increasing it. What do you think? What should I do? Write down the 16, decreasing it. Everybody good? So let's do it. Where does it go? Under financing. This is going to be, boy, I didn't make that. Dividends paid or dividends declared. How much was it? 16. What should I put around that? Brackets, because it's less cash. Think about what happened to cash and pretend you paid it with cash, right? What did you do? Debit, retained earnings, credit cash, right? Okay, everybody got it? So now we're done with retained earnings. You can check off that account. So do so. You don't have to go in order, is my only point of that. Okay? Well, let's do easy stuff. Let's do really easy stuff. Let's do accounts receivable. Where does it go? Where do all the changes in all the current assets go? Under operating. Changes in current assets. Now here's the deal. If you have more of a current asset, I bet you anything that gives you less cash. If your receivables go up, guess what? You didn't collect all your sales. If your inventory goes up, guess what? Ultimately, you have to buy it, probably with cash. Although accounts payable might be what increased, right? But that's okay. We're going to do accounts payable too, right? If you didn't pay your bills, what happens? You don't pay your bills, what happens to the current liabilities? Get more cash. What are you paying down? You have less cash. What are you paying with? Cash. And we pretend on the accounts receivable and the inventory and the prepaids, all the current assets, that if they go down, we have more cash. Well, I guess that's kind of true, right? Because you didn't replace them. Okay? It's a way to think about it. So here's the deal. This is easy. Increases in current assets do what? Reduce cash. That's it. Decreases in current assets do what? Pretend you sold them for cash. I'm not kidding. Really. On the current liabilities, what do you want to do? Increases in them. What'd you do? You borrowed money, didn't you? They'll increase cash. Ah. They're exactly opposite from each other. Well, yeah. Assets are debits and liabilities are credits. They have to be opposite of each other, don't they? Right? When I buy a current asset, I have less cash. When I increase a current liability, I have more cash. Right? They're opposite. Okay? All right. What if I decrease a current liability? I paid it with cash, I have less cash. Everybody got those? Okay? All right. So, next time we're going to do one of these again, right? We're going to do the other one. You guys have worked it by next time. You'll know what I'm talking about better here. A lot of looks like, oh my gosh, what's he doing? It's so hard. It's not. Okay? It's not really a very big deal. Okay, accounts receivable is one of the current assets. What happened to it? What did it go up by? 80. So I have more accounts receivable by 80. What does that mean? You did not collect 80 of your sales. Right? Those sales are included in net income, aren't they? Look at the revenues down there, it's 750. 80 of that you haven't collected. So in my net income is 80 that did not convert to cash. Everybody got it? So if I have more of accounts receivable, I have less cash. And that's it. And you know what? What's really fun now is you can check off accounts receivable already. Now here's the deal. On the current assets and current liabilities, you only put in the change. Already you noticed on retained earnings, we put in both the increase and the decrease, didn't we? On all the non-current assets, non-current liabilities, right? Long-term liabilities. And on the equity, I show both. And here's the reason. Listen to this carefully. How many transactions are there in the current assets? How many times do you debit accounts receivable? How many times do you credit accounts receivable? Every time I sell anything, I debit accounts receivable. Every time I collect from the customer, I credit accounts receivable. Lots of times, huh? How about inventory? Every time I buy it, debit inventory. We've got perpetual. Every time I sell it, credit inventory. Over and over and over, huh? Millions of transactions. And the dollar amount in my current assets is fairly small in total, huh? And the change is fairly small. And it just hits operations. We're just going to show the change instead of all the debits and all the credits, both. It doesn't need. But think about now the non-current assets, land, building, equipment. How many times do you buy land in a year? Even a big company. Not very many. How many times do you sell it? Not very many. You got the idea? They're huge transactions and not very many. So we show both buying and selling. So I'm going to show under the investing, I am going to show both the increases and decreases. Under operating, I'm only going to show the change, okay? So both increases and decreases under investing, and under financing, same thing, both increases and decreases. Same idea, how often do you issue a bond payable? Not very often. How often do you pay one off? Not very often. Got the idea? And they're big transactions. So it's better exposure, more information. That's the idea. So you can remember it, but also it makes sense, doesn't it? Okay? So I'm just showing the change in that account receivable. So those are easy. I'm going to do it quick. Check off accounts receivable. Are there other current assets? You bet. What happened to inventory? Increase or decrease?
Decrease from 30,000.
Yeah, and we pretend we sold it for cash. Okay? If every other account stays the same, right, except for cash, we must have more cash, right? So now you can check off inventory. No kidding. How about prepaids? That's current too, isn't it? What happened to it? Increased prepaids by 2. And what does that mean? Yeah, you bought them for cash. Put a check mark next to it. We're done with that. Now you're to plant and equipment, and it gets hard there. So what I would suggest is what? Let's go down to the current liabilities. Accumulate points. And then figure out the hard stuff. Okay? So what happened to accounts payable? Increase or decrease?
Increase.
I didn't pay a whole bunch of my bills. What do you think happened to me? I got more cash because I didn't pay my bills. That's it, you guys. How much was that? 75? Okay. Put a check mark next to it. Wow. Accrued liabilities, increase or decrease? Decrease. What did I pay it with, you guys? Cash. I have 10 less cash. Everybody good? It's that simple. Not kidding. This isn't bad, is it? This isn't too bad at all. Right? You good? Okay. Now we got to do the harder stuff. What do you want to do? Maybe plant and equipment? Here's a suggestion for you. Think about how you change plant and equipment. Plant and equipment. What account goes with it? You depreciate them, don't you? So accumulated depreciation. That's it, right, guys? Okay, what are the possibilities with plant and equipment? Let's see. Let's write down what we know. What did it start out at? 420? Is that right? What did it end up at? 500? How much was added minimum? 80. So we do add the plant and equipment. At least 80 was added, but what else could have happened? This is where it gets hard. Could have sold some. What do you do when you sell some plant and equipment? Credit it, don't you? Right, guys? But at the same time, what would you do to accumulated depreciation if you sold some? You'd retire the accumulated depreciation, wouldn't you? Over here? So what happens with accumulated depreciation? It starts at 70, right? It goes up to 85. If they didn't retire any accumulated depreciation, if there's no debit here, right? There's no elimination of something that was sold, then what would be the case? There's 15 of what, you guys? How do you increase accumulated depreciation? With a credit, but what are you debiting? Depreciation expense, you got it. So this is going to be depreciation expense on this side. It's at least 15, right? So the possibilities are debit plant and equipment and credit cash if we pretend everything is cash. That's this entry here, right? Another one is debit depreciation expense and credit accumulated depreciation. Everybody good? Right? That's true, isn't it? Okay? That's this one over here. And then there's also this possibility, right? Which would be what? Debit cash, credit plant and equipment for any sold, right? What else would I debit? The accumulated depreciation on whatever I sold, right? Obviously, if it's land, it wouldn't have any, but building and equipment would. And then what else is there when you sell something? Plant and equipment. What do you typically have? Either a gain or a loss, right, guys? And where would that gain or loss be? It would be in the income statement, wouldn't it? So I have to adjust my operations by that gain or loss. That's where this gets hard. So what information did they give me? Take a look at that. Do you know what depreciation expense is? Anybody see it? No. Did they give it to you? No?
Accumulated depreciation is 15.
Yeah, I can see it went up by 15, but I might have retired some. And did I retire some? Yeah. I sold equipment for $18,000. Just think about the journal entry, you got it made. Debit cash, 18. The original cost was 30. Credit plant and equipment by 30. The accumulated depreciation was 10. Debit accumulated depreciation by 10. Well, that's 28 debits and 30 credits. What else do I have to have? There was a loss on sale of equipment at 2. Look at that income statement. It shows a loss on sale. So the loss on the sale is 2. Okay, what I want to do is I want to explain this change here of 20, right? I credited plant and equipment by 30, and I debited accumulated depreciation by 10. I want to explain that 20 change, you guys. But what do I have? I only have cash coming in of 18, don't I? So I've got to do something with the 2 to get up to the 20. Okay? So here we go. Accumulated depreciation got debited by 10. Everybody agree? That's that debit right there. Plant and equipment got, whoops, I put it in the wrong place. Accumulated depreciation got debited by 10. Plant and equipment got credited by how much? 30. Does everybody see that this 30 30 netting with that 10 is the 20 change here, right? The 20 change. Now I'm going to explain that over on my statement. So what I'm going to do is I'm going to say, oh, by the way, where am I going to put the sale of the equipment? What kind of an asset is it? Equipment?
Long term.
Long term, you bet. Where does it go? Investing, you got it. Sale of plant and equipment, whatever it was. How much? I sold it for 18, just the cash, you guys. And then so I sold it for 18. Ah, but I want to explain a 20 difference, don't I? What else do I have to do? Add back the loss. Got it? Add loss on sale, equipment of 2. What is 2 plus 18? 20, and I've explained this 20 difference. Got it? Now, what else happened to plant and equipment, obviously? If it started at 420 and I sold 30 of it, it's now 390. Somehow it got up to 500. What else happened? They bought 110. You got it. That must be this entry. We assume everything's for cash at this point. Okay? So what do you want to do? I want that cash. Where do I want it at? In investment. This is going to be purchase plant and equipment. Oh, and I show both because these are big numbers, right, guys? 110. Now you can check off plant and equipment because you did both the 110 side and the 30 side. What's left? Depreciation. How much is it? If you started at 70 and you took out 10, that made it 60, and now it's 85. What was depreciation? What do you think, guys? Starts at 70, goes down by 10 to 60, and now it's all the way back up to 85. What happened? You put 25 in there. See, these are journal entries you already know, huh? You're just using them. It's credit accumulated depreciation. Guess what the debit had to be? Depreciation expense. Now, what am I going to put under investing for that? No cash went anywhere. Nothing. But what did I do with the depreciation expense? I took it out of net income, didn't I? So that 56 net income is too low from a cash basis standpoint by 25. Oh, so I'm going to add back the depreciation expense. Wow. Don't put accumulated depreciation in here. Put depreciation expense in here, please. Okay? So that's going to be 25 gets added back. Okay? We're getting there, you guys. All right. How about long-term investments? It says they sold them for 12. They cost 7. The account went down by 7. I don't need to write that T account for that. I know what happened. How much was the gain? Look at the income statement. It was 5. What did they do? They debited cash for 12. They credited long-term investments. How much? 7. And they have a gain of 5. What do you want to do? What do you want to? Where does this go, by the way? Long-term investments. What kind of account is it? Non-current asset. Where do they all go? See why I want you to have down where things go. And you can figure it out no matter what account is. Okay, so I got 12 in non-current assets increase, right? Or decrease, I'm sorry. So I have sale of investments this time. And that generated 12 for me, didn't it? Everybody agree? It's true. Okay, that took care of that. But I only want to explain a change in the account of how much? 7. That's what changed in the account. So what do? Should be in here. Didn't leave enough room. Deduct the gain. So gains get deducted and losses get added. Isn't that funny? Right? So that is going to be, how much was the gain? 5? Okay. So I'm going to deduct the gain of 5. All right? You got the answer there on the back of it. See how they did it. Okay? Hard to see that.
So what did you break down in that?
I just wrote down gain, deduct the gain, 5.
Deduct gain.
Deduct. Subtract. Deduct gain. I can't see it. It's because my screen is so small. Okay, that's deduct gain. Okay, so yeah, we're getting rid of what? I put look at your income statement. We put the 5 gain into net income, right? But that has nothing to do with operations. So I don't want it included in operating income up here, so I take it out, take the 5 out. Same with the 2 loss. I didn't want the loss out of there, right? Those are gains and losses on what? Investing activity, right? Not operating. That's all we're doing. So I'm just moving the gain or loss from one place to the other is all I really did. What I want to show is the 18 cash coming in for plant and equipment and the 12 for the investment, right? I want to show the real cash under investing activities. That makes sense? But I don't want to double count the gain or double count the loss. So I have to adjust operating. And that's the toughest thing to get, you guys. That and maybe the depreciation, right? Okay? So now what we can do is we can check off investments, right? Because we've got the 7 explained there. Between the 12 less the 5, right? So now what do we have left, you guys? Bonds payable? What happened to bonds payable? It doesn't say anything down below. What could happen with bonds payable? It could get paid off, which would be using cash, and then you could issue new ones, which would be generating cash, right? What do you do when you pay off the bond payable? Credit cash and debit bonds payable, don't you? What do you do when you issue one? Debit cash and credit bonds payable. That's what we do, huh? So what happened here? They don't say anything down below, so I guess we did what? We just issued 25,000 more bonds payable. Okay, you guys, where does it go? Long-term debt. Long-term debt. Financing. So bonds payable, issue. So issue bonds payable, we might say something like that. How much? 25. Plug it in. Okay? Check that one off. Now, deferred income taxes is kind of a weird thing. Has to do with net income. We have, and we'll do this next time, 8,000 or 8 million or whatever it is, 8 of more deferred income tax. It's long-term borrowing from the federal government. We will put that up here. So the increase in deferred income tax payable. We'll plug that in up here too. Okay? So that's going to be 8. Okay? So I have an expense that did not use any cash. So that's going to be added to my cash flows. And then common stock went down by 40. What must they have done? Must have bought back some treasury stock. So this is kind of a tough problem. If it went down by 40, what happened, you guys? Debit, common stock, credit, cash. Where does that go? Retire common stock. Where would it go? Under financing. Why does it go under financing, gang? Because it's stock, right? Okay. So if I retire the common stock, what am I going to call it? Financing activity, and it's going to be what? Less cash, because I paid the cash out to retire. Okay? So I want you to go give this thing a try. By the way, when you check off that account, what have we now done? All of them. So flip the page over and look at those totals. What do we have for total cash flow from operating activities? 104 positive. It's not 56. It's 104 came in from operating. Okay? The big difference is depreciation in it. Okay? What do we have for investing? Negative 80. That's what went out. Okay? 18 plus 12 less 110. It's negative 80. All right? And what do we have for financing activities? This one is negative 31. Cash going out. Okay? Now what's 104 less 80 less 31? What do you get? Negative 7. Ta-da! As soon as you get the totals to add up, you're done. So redo this problem, slowly, methodically, right? And then work the other one. Next time, I'll do whatever you want. We can work the other problem, right? And we can work things from chapter 4 on investments, right? And the time after that is a quiz. Of course, there's always a quiz. Oh, that's terrible, isn't it? Screw you up. Okay, guys.